Hi guys, we are back and now we'll be building up the whole armory, the whole repertoire of how exactly is tax calculation done for an individual. Today we'll be focusing on calculating basic tax levels for an individual and understanding how many different ways are there for an individual's income tax liability to get calculated. What are some of the deductions? What is the meaning of the word deduction? What is an allowance? We'll be discussing all of these points in detail, and we'll look at a lot of numerous different types of situations where you have different values given to you and you are expected to calculate the tax liability of an individual. But before we do that, let's understand how what exactly does your income tax computation look like, and what exactly is an income tax computation. Now, any individual who earns income can primarily earn income from a couple of sources. He could either be working as an employee somewhere and he would be getting salary. So that would be his employment income. He could have a house property in his name, on which he is given that on rent and he is getting rental income. So that could be property income. He could also have he could have made an investment somewhere and he's earning interest or dividend on that particular amount, on that particular amount that he has invested. So these could be multiple ways in which he is earning income. Also, if he has sold a capital asset, what is a capital asset? We'll see that later. But if he has disposed of a capital asset and he has had some gain on that, then even that amount would lead to a capital gain, and that also will be a source on which he will be taxed. So, our first job is to bring together in one place income from all sources and understand how is, first of all, taxable income calculated, point A, and then how do we calculate an individual's income tax liability. What you can see on your screen right now a is a format in which we are going to accumulate all the income that an individual earns. So, on a broad level, we are going to divide income into three categories. There is non-savings income, then there is savings income, and then there is dividend income. Okay, now what is savings income? Assume that an individual has made an investment in a bank fixed deposit, in a building society deposit. Like when you take an apartment in a particular building, you have to keep a security deposit there. So we are including those as well. He has invested in bonds and he is getting interest income on that. So that is accumulated money deposited somewhere, which we can call as savings of the individual. That income is savings income. After that, there the second category of income is non-savings income, which are basically, earned by putting yourself to work every day. That includes employment income where an individual is working as someone's employee and getting a salary. As I told you, if he has a property which he has given on rent to someone, that rental income is his property income, followed by pension income. So after an individual retires, his employer might continue to pay him a certain amount every month in return of the service that he has provided in the past. That is your pension income. And if you have set up your own business, in that business you conduct you say you sell goods and services throughout the year and you earn some profit by the end of the year, that is your trading income. Okay, so non-savings income primarily has four categories: employment income, property income, pension income, and trading income. We saw savings income, which basically included interest, and then you have dividend. Now, what is dividend? When a company, see, what a company does is it raises money from people like you and me. So all of us contribute money to the company and we become shareholders of the company. What are shareholders? Shareholders are part owners. Okay, naturally, when we have invested money in the company, we expect that when we make an investment somewhere, we should be compensated properly for that. And naturally, when you make an investment in a company, you are carrying a risk. You also expect to be compensated. Now, what the company does is after it has, prepared its financial statements for the year, it realizes what profit it has earned. Then it would want to distribute a part of that profit to the individual shareholders or part owners. That distributed profit is called dividend. Okay. The total of all these three, non-savings, savings, and dividend, is your total income, followed by, so this is your cumulative amount from all sources. Now, from this total income, the tax authorities allow you to deduct certain amounts before arriving at your taxable income. Now, what is taxable income? Taxable income is that income on which tax can be levied, and this has to be calculated according to the rules and regulations that have been laid down by the tax authorities. Now, for example, in some cases, the tax authorities say that if you have taken out a house and if you have purchased a house, you have taken a loan to purchase the house, you are paying interest on that loan, then that particular interest is also allowed as a deduction. So there are different rules. We'll study them in due course. Okay. Now, in case of individuals, the taxation happens using a slab rate system. Now, what is a slab rate? See, there could be two ways of levying tax on individuals. Okay. What are these ways? One way is a flat rate system. What is a flat rate system? Whoever the person might be, say his total income is 100 and there is a flat rate tax of how much? There is a flat rate tax of 20%. So if you earn an income of 100 rupees, you will have to pay 20% tax. Then there is another person who earns an income of 1000, this person will also get taxed at the rate of 20%. And then there is a third person who has earned 10 rupees, he also gets taxed at the rate of 20%. That is a flat rate of taxation. Okay. And then we have, most countries have an approach where they tax individuals on a slab rate basis. Now, what is a slab rate basis? Please try to understand with me. Here, if you see, on the first 37,700 pounds of your income, that is the first slab, which is known as the basic rate band. Then if you earn income which is more than 37,700 pounds, you are considered richer. You are a little better now. Then you enter the higher rate band, which runs from 37,701 to 125, 140. And the highest tax rate is above 125, 140 pounds. Now you are ultra rich. Now you are elite. When your income is more than 125, 140, then you enter the additional rate band. There are different rates of tax for each band. Okay. If you are in the basic rate band and you have earned if you have earned savings income, then that will be taxed at 20%. If you have earned dividend income, it will be taxed at 8.75%. Suppose you are in the additional rate band and you have earned non-savings income, it will be taxed at 45%. Now, how the application of these tax rate happens, we'll see all of that. Just give me a minute. And always remember, in your tax exam, the order of taxation will always be non-savings income first, savings income later, and dividend income at the fag end. Now, I'm going to do a couple of easy calculations with you to help you understand. Okay, right now, I see this is actually not the entire picture of how tax is calculated. Please understand. I'm only trying to give you step one. Okay, now there are a lot of other rules relating to personal allowances, deductions, blah, blah, blah. We haven't considered all of that yet. So this is just a simple understanding of how tax is levied. Now, Riddhi has taxable trading income of 21165 pounds and employment income of 3000 pounds. She has no savings or dividend income. Calculate her tax liability. My only objective is to tell you how slab rates work. Okay, so what is total income? Total income will be 21,165 worth of trading income plus 3000 worth of employment income. Okay, how much does that come to? 21165 plus 3000. Let me tell you, this is non-savings income. Okay, this is non-savings income. Now, I'm telling you again, there are a lot of other provisions that you are going to study later, but right now my only focus is to tell you how to apply the slab rates. Okay, now from total income of an individual, the tax authorities say that, you know what, we are not going to tax the entire amount. Imagine you are a person who has just started earning, and you live in a city like Mumbai or you live in a city like Delhi. You earn 30,000 rupees each month. Now, if you are earning 30,000 rupees, a part of that will go towards paying rent of the house, will go towards buying groceries, and the basic necessities of life, which is food, clothing, shelter, internet subscription, maybe not a Netflix subscription, but these are four non-negotiable expenses that every individual is making today. You need petrol for your vehicle, you need clothes to wear, you need to buy food grains. Now, a person who has just started earning will end up thinking that, you know what, I earn 30,000 and most of that money is getting spent in, managing the basic necessities of life. And now you are asking me to pay tax. And a person who is earning 1 crore, you are asking him also to pay tax according to the same rates. That's not fair. At least still see a certain amount of income that we are earning, it's basically to keep ourselves alive. It's not really leading to any growth. So the tax authorities in the United Kingdom came up with an idea called as the personal allowance. Basically, this is an amount which, according to the tax authorities, this is the bare minimum amount that any individual will need to have a basic quality of life, which includes having a roof over your head, paying for your food, paying for your petrol, and all of these bare minimum necessities of life. So we, although it is a capitalist world, we still have certain socialist principles which guide us. So what we are saying is we'll not levy tax on at least this amount, which is the amount that you have earned 30,000. Out of that, a major chunk is getting spent towards maintaining the basic necessities of life. So let us not tax those who have just started earning. Let us focus on taxing people whose income is beyond this basic level of earning. So what are these expenses? These are your personal expenses which you are incurring, which in many ways is an expenditure to keep yourself alive. This amount will not be taxed. Income earned over and above this amount will be taxed. And what is this amount called? This amount is called personal allowance, because this is for your basic non-negotiable personal needs. So what does HMRC say? HMRC says that if your total income is 24,165, we know that you will need to incur a certain expense to keep yourself alive. To that extent, we will not tax you. We'll tax you beyond that. So from this total income, I will deduct an amount called as personal allowance. That basic amount which I have to spend on myself, on my own person, to keep myself alive and kicking. That amount is 12,570. Now, this 12,570 is not a number that I have made. HMRC has said that if you are an average individual living a basic life, this is the amount that you will incur for keeping yourself alive. We'll not levy tax on that. So, if your total income is 24,165, from which now you are deducting 12,570 worth of personal allowance, that means your taxable income is how much? Your taxable income is 24,165 minus 12,570, which is 11,595. How did you arrive at taxable income? This is total income minus personal allowance. Okay, and on this amount now I'm going to calculate my tax. What type of income is this? This is non-savings income. So you come to this column. Okay, and what is the income level of the individual? The income is 11,595, which is in the range of 0 to 37,700. Okay, so on this I will have to calculate tax at the rate of 20%. Okay, I will call it basic rate band. This is non-savings. Okay, so what is your tax liability? 11,595 into 20%, 2,319. The person is in the basic rate band. This is how you apply a slab rate. Okay, look at the next one. With every passing question, you will start understanding things better. Now, Navansh has taxable trading income of 43,765 and employment income of 7,000 pounds. He has no savings or dividend income. Calculate his tax liability. The first thing is, before calculating tax liability, you need taxable income. Before calculating taxable income, you need total income. Okay, so what all income has this person earned? He has earned trading income of 43,765 and he has had employment income of 7,000 pounds. Both of these are non-savings income. So this is his total income 43,765 plus 7,000. From this, you will subtract personal allowance. How much will that be? That will be 12,570. Okay. This is the same amount for all individuals. There are some additions to this knowledge, but we'll come to that in a minute. Personal allowance is 12,570 pounds. What is your taxable income now? Taxable income is 50,765 minus 12,570, which is 38,195. Now look at the slab rates. Okay. If your income is between 37,701 and 125, 140, then you are in the higher rate band. Okay. So now pay attention to how exactly am I calculating the income belonging to this person. Okay. So 0 to 37,700 is the basic rate band. So on 37,700, you will calculate tax at the rate of 20% basic rate band. Okay. Now total income is how much? Or rather, taxable income is 38,195. Out of this, 37,700 falls in the basic rate band. Now, the question is how much income falls in the higher rate band. Okay. So that will be 38,195 minus 37,700, which is 495. Now this 495 falls in the higher rate band. When you are in the higher rate band, what is the tax rate? Tax rate is 40%. So 4, here I will write down 495 at the rate of, sorry, 495 at the rate of 20, not 20, sorry, at the rate of 40%, which is your higher rate band. Okay, so 37,700 into 20% and 38,195 minus 37,700 into 40%, that is 198. So what is the total tax liability? 7540 plus 198, which is 7738. This is the total tax liability of the individual. So you see, first question was on basic rate band individual. Second question is the individual is in the higher rate band. Now look at the third illustration to see when he is in the additional rate band. Okay. Sharvari has taxable trading income of 1,35,000 pounds and employment income of 33,680 pounds. She has no savings or dividend income. Calculate her tax liability. Okay. So trading income 1,35,000. Employment income 33,680. Total income 168,680. Personal allowance. See, there is a concept called reduction of personal allowance, which I will explain it to you in the next 5 minutes. Right now, just accept the fact that at this income level, personal allowance is zero. Why that is so, I will tell you later in the next 5 minutes, I'm promising. Right now, just take this as a fact of life. Okay. So now what is your taxable income? Your taxable income is 168,680. The income is higher than 125 170. Okay. So not 125 170, 125 140. Okay. The income is higher than 125 140. Individual is in additional rate band, not even higher. Individual is in additional rate band. Now again understand how do we apply the slab rate. Okay, on 37,700 tax at the rate of 20% basic rate band. Okay, 37,700 tax at the rate of 20% basic rate band. Then after that, what slot do you enter? See, this is your non-savings income. Okay, then non-savings income, once you cross the basic rate band, where do you go? You go into the higher rate band. Higher rate band is 37,701 to 125, 140. This is higher rate band. So the question is, how much income gets taxed in higher rate band. Basically 125, 140 minus 37, 700 gets taxed in the higher rate band, which is 87, 440. Okay. So this is 87, 440 at the rate of 40% higher rate band. And how much income is not yet taxed? So 168, 680 minus 125, 140. How much is that? This amount 168, 680 minus 125, 140. 43, 540. This much amount is not yet taxed. It will be taxed in the additional rate band at the rate of 45%. So 43, 540 at the rate of 45%. This is your additional rate band. Okay. So 37, 700 into 20%, 87, 440 into 40%, and 43, 540 into 45%, 19,593. This is your additional rate band. Okay. And now what is your total tax liability? Total tax liability is 7540 plus this plus 19,593. This is how tax liability will be calculated if you are in the additional rate band. Okay, very important to know how this works because this will be there. This will get tested in every single question ever. Okay, so make sure that you redo these questions at least once. Now, Nandini has an annual salary of 1 lakh. How much additional tax would Nandini have paid if, in addition to her annual salary, she had received a taxable performance bonus of 25,140 during the year? Now, this question will link us to the next concept, which is understanding personal allowance in more detail. Okay, so here I had told you, accept this as a fact of life that at a certain income level, personal allowance is zero. Now we'll delve deeper into understanding how is personal allowance calculated. Coming back to our discussion on personal allowance. So we discussed what is personal allowance. Now let's see how. So by the way, the number is 12,570. So according to the tax authorities in UK, what they think is 12,570 is what a person would need to carry on with his life and pay for his basic personal non-negotiable expenses. Okay, so with that perspective in mind, this does not this amount is not taxed, which means if your income is 30,000, then 12,570 is deducted from this 30,000 as PA, and you have to pay tax only on the amount over and above this 12,570. So your taxable income will be 30,000 minus 12,570, which is 17,430. Okay. Surplus PA is lost. Say your total income is 10,000 and your personal allowance is 12,570. Now, from 10,000, you cannot subtract 12,570, right? It will create a negative number. So 10,000 minus 10,000 out of your total 12,570 personal allowance, you utilize 10,000 and you reduce the taxable income to zero. 2,570 was not used. This is lapsed. Okay. This does not get carried forward to the next year. And this is exactly how you go from total income to taxable income. And what is the order of adjustment of personal allowance? First, it is adjusted against non-savings income, then against savings income, and in the end against dividend income. Okay. And you can reduce PA only from total income, not from capital gains. Okay, be mindful of that. Non-savings first, then savings, and then dividend income. Okay.